The day your spouse dies, the federal government quietly reclassifies you, and everything you own becomes exposed in ways it never was while they were alive. Nobody tells you this in the hospital. Nobody mentions it at the funeral home. Your financial advisor sends a condolence card and waits for your call. And in the silence of that first year, while you are learning to sleep alone and figuring out which bills were in whose name, a series of financial traps are armed, one, by a tax code and a Medicaid rulebook that treat widowhood not as a tragedy, but as a taxable event. Carolyn Marsh is 72 years old. She lives in a colonial revival on the north side of Naperville, Illinois. Her husband, Dennis, was a civil engineer, methodical, careful, the kind of man who color-coded his tax files and kept a legal pad on the kitchen counter for grocery lists. Dennis died of a cardiac event in February 2024. He was 74. He left Carolyn a paid-off house worth $485,000, a combined IRA balance, now rolled into Carolyn's name, of $740,000, a joint brokerage account with $190,000, and a Social Security survivor benefit of $3,100 a month. Dennis kept their finances immaculate. Carolyn had never once worried about money. She worried about everything else. She worried about whether to sell the house. She worried about whether to move to Arizona where her daughter lives. She worried about the furnace and the roof and whether to keep the second car. What she did not worry about, what nobody warned her about, was the cliff. Here is the cliff. In 2023, while Dennis was alive, Carolyn and Dennis filed their taxes as married filing jointly. Their combined income, Dennis's pension of $2,800 a month, both Social Security checks and IRA distributions, totaled approximately $118,000. Their effective federal tax rate, 14.2%. Their Medicare Part B premium, $174.70 a month each. Their Medicaid asset protection status, if either had needed nursing home care, the community spouse, the healthy one at home, could have protected up to $154,140 in assets and continued to receive income. Then Dennis died. In 2024, the year of Dennis's death, Carolyn filed as married filing jointly for the last time. Her income that year included Dennis's pension through February, both Social Security payments for the full year due to the survivor benefit structure, and a $90,000 IRA distribution she took on the advice of a well-meaning but not Medicaid-aware financial advisor who told her to rebalance while the market is up. In 2025, Carolyn filed as a single taxpayer for the first time. Her income, $37,200 in Social Security survivor benefits, $28,000 in required minimum distributions from the IRA, and $6,400 in brokerage dividends. Total, $71,600. Effective federal tax rate, not the 14.2% she paid with Dennis, 22%. Her standard deduction dropped by $15,750. Her bracket thresholds compressed by nearly half. Her Medicare Part B premium, based on that 2023 joint return with the $90,000 IRA distribution, jumped to $349.40 a month under IRMAA Tier 1, exactly double what she paid 2 years earlier. And her Medicaid protection? The Community Spouse Resource Allowance that would have protected $154,140 of her assets if Dennis had gone into a nursing home? Gone. Carolyn is now a single applicant. If she needs nursing home care, she spends down to $2,000. The full machine. No spousal protection. No income allowance for the at-home spouse. No community spouse. Because there is no community spouse. That is the widow cliff. And Carolyn walked off it in slow motion while everyone around her called it grief. If that lands the way it should, if you are sitting there running the math on your own situation, smash that like button right now. Not a courtesy. A signal that you understand what's at stake. Because this bulletin is going to show you exactly how to see the cliff before you reach the edge. Let's run the real numbers. Because the widow cliff is not one trap. It is 4 traps that detonate in sequence. And most people don't realize they've been hit until the 3rd or 4th explosion. The suits at the agency want me to remind you this is not financial advice. It is a survival guide for an unguarded vault. Talk to a fiduciary CPA before you move a single dollar. When Dennis was alive, Carolyn and Dennis's $118,000 joint income sat comfortably inside the 22% bracket threshold for MFJ filers, which in 2025 runs to $201,050 before you hit 24%. As a single filer in 2025, Carolyn hits the 22% bracket at $48,476. She was at $71,600. She is solidly in the 22% bracket, but the bracket boundary is less than half what it was as a joint filer. More damaging, her standard deduction dropped from $29,200 as a joint filer to $15,700 as a single filer aged 65 and over. That $13,500 swing means $13,500 more of her income is exposed to federal taxation annually, without her earning a single additional dollar. She lost $13,500 in deductions the moment she became a widow. Annual federal tax cost of widowhood for Carolyn, approximately $4,200 more per year than she paid with Dennis at equivalent income levels. Over a 20-year retirement horizon, that is $84,000 in additional federal tax paid purely because Dennis died first, not because her income increased, not because she made different financial decisions, because the tax code treats her death of a spouse as a bracket reduction event. Medicare's Income-Related Monthly Adjustment Amount, IRMAA, uses a 2-year look-back. Your 2026 Medicare premiums are based on your 2024 modified adjusted gross income. In 2024, Carolyn's MAGI included that $90,000 IRA distribution. Her 2024 MAGI, approximately $148,000. At that income level, as a single filer, Carolyn hits IRMAA Tier 2. Part B premium at IRMAA Tier 2 for a single filer in 2026, $454.60 per month. The base Part B premium for someone below the IRMAA threshold, $185.00 per month. Carolyn is paying $269.60 more per month, $3,235 more per year, directly because of an IRA distribution she took 18 months ago that now reads against her as a single filer at a fraction of the income threshold it would have cleared as a joint filer. Knife in the kidney. Stealth tax layer 2. Three-headed beast, except this beast has 4 heads and they bite in different years. Before Dennis died, their combined provisional income, half of combined Social Security plus other income, kept a portion of Social Security below the 85% taxable threshold. As a single filer, Carolyn's provisional income calculation crosses both thresholds, $25,000 and $34,000, faster and harder. At her income level, 85% of her $37,200 Social Security survivor benefit is now taxable. That is $31,620 of what feels like a survivor benefit being fed back into taxable income, an additional $6,900 in federal tax compared to her joint filing years on money the government already taxed when Dennis earned it. This is the one with the longest fuse and the largest explosion. As a couple, Carolyn and Dennis had structural Medicaid protection built into federal law. Under Social Security Act Section 1396 R-5, the Spousal Impoverishment Statute, if one of them had entered a nursing home, the community spouse could have kept the CSRA up to $154,140 in countable assets as of 2026. The community spouse would also receive a minimum monthly maintenance needs allowance, MMMNA, of at least $2,555 per month in income, with states allowed to go higher. The institutionalized spouse could qualify for Medicaid while the healthy spouse kept the house, kept the car, kept meaningful assets, and kept living. Dennis is gone. There is no community spouse. Carolyn is a single applicant. She spends down to $2,000, full stop. Her $740,000 IRA countable in Illinois. Her $190,000 brokerage account countable. Her savings countable. Her house exempt while she's alive, but subject to Illinois estate recovery after she passes, and Illinois participates in MERP fully, pursuing recovery against the probate estate for all Medicaid benefits paid. Total countable exposure, $930,000. Spend down target, $2,000. The gap between where Carolyn stands today and where Medicaid says she must be before they help her, $928,000. Nearly $1 million that can legally be consumed before the state picks up a single day of nursing home costs. Tell me in the comments right now, how old are you this June 2026? And if your spouse died tomorrow, how much of your combined estate would immediately lose its Medicaid spousal protection? That number in the comments might be the most important math you do this week. Here is the open loop I need you to hold. There is one specific move, a single legal instrument, that can restore a form of Medicaid protection for the surviving spouse, even after the other spouse has died, without a 5-year wait, without a trust, without transferring a single asset. It sounds impossible. It exists. We're going to get there. Hold that. Let's talk about who designed this and why it works the way it does. The Community Spouse Resource Allowance and the Spousal Impoverishment Protections were created by the Medicare Catastrophic Coverage Act of 1988, one of the few pieces of legislation Congress has ever passed and then partially repealed within a year due to public outcry. The income protection provisions survived the repeal. The asset protection provisions, the CSRA, survived and were codified permanently under Section 1396R-5 of the Social Security Act. Here is the misalignment Congress never fixed. Those spousal protections apply only when one spouse is institutionalized and the other is alive and in the community. The moment the community spouse dies, even if the institutionalized spouse is still alive, still in the nursing home, the CSRA protections dissolve. The surviving institutionalized spouse is reclassified as a single applicant. Assets that were protected under the spousal rules become countable overnight. This is sometimes called the snapshot problem, and it has been litigated in Medicaid administrative proceedings across the country with inconsistent results. But the trap for Carolyn is the mirror image of that scenario. Carolyn is the healthy surviving spouse. She never needed a nursing home. The spousal protections, the CSRA, the MMMNA, were her shield against the spend down that would have been triggered if Dennis had gotten sick. Now that Dennis is gone, those protections are moot. She has a different exposure. She is now a single applicant Medicaid prospect, with a full spend-down machine waiting for the moment she herself needs care. The $900 billion long-term care industry knows this. The annuity salespeople know this. The Medicaid planning attorneys who charge $8,000 to $15,000 to draft irrevocable trusts know this. The nursing home billing offices that begin the private pay clock the moment you walk through the door, they know this. The person who does not know this is Carolyn, sitting in her Naperville colonial with Dennis's color-coded tax files still in the cabinet, believing that because he kept everything organized, she is protected. The tax code's treatment of single filers is not an oversight. The bracket compression, the IRMAA thresholds cut nearly in half for single filers, the Social Security taxation cliffs, these are structural features of a system that collects more revenue from people who were previously protected by joint filing status. Every year, approximately 900,000 Americans become widows or widowers. The majority of them are women. The majority of them experience an immediate and significant reduction in financial protection that nobody in the bereavement industry mentions and nobody in the financial services industry proactively addresses. Send this video to one person whose spouse is still alive, right now, today, before the end of this bulletin. Because the planning that prevents the widow cliff happens before the death, not after. The moves that protect Carolyn needed to happen when Dennis was alive. The moves that protect your surviving spouse need to happen now, while you are both here to act. Send it. Don't bookmark it. Send it. Here is the operational playbook. 4 moves, all legal, all documented, all executable. Some before death, some immediately after, one that most people have never heard of. Save this video to a playlist titled Retirement Survival Manual right now. What we are about to cover is information that Medicaid caseworkers will not volunteer, that the hospital social worker will not mention, and that most financial advisors are not trained to give you. This is the most time-sensitive move on this entire list, and it requires both spouses to be alive to execute it at maximum effectiveness. Here is why. While you are married and filing jointly, your tax brackets are wide. In 2026, the 22% bracket for MFJ filers runs from $96,900 $951 to $201,050. For single filers, it runs from $48,476 to $103,350. That gap, the space between those two bracket ceilings, is your Roth conversion runway. While both spouses are alive, you can convert traditional IRA dollars to Roth at the 22% or lower rate, up to $201,050 in total income. After one spouse dies, that runway shrinks to roughly half. The exact strategy: calculate your joint taxable income each year. Fill the space between your current income and the top of your target bracket with Roth conversions. For a couple with $80,000 in baseline income and a goal of staying in the 22% bracket, you can convert approximately $121,000 per year before hitting the ceiling. At that pace, a $740,000 IRA can be substantially converted in 6 to 8 years, removing it from the Medicaid countable asset pool in states that exempt Roth IRAs, eliminating the future forced withdrawal tax hit of the spend down, and permanently reducing future RMDs that would otherwise drive IRMAA exposure higher every year. The Secure Act 2.0 raised the RMD age to 73, which extended the conversion window for many retirees, but it also means larger future RMDs if you do nothing, compounding the single filer tax hit after the surviving spouse is alone. State nuance. In Illinois, where Carolyn lives, retirement income, including IRA distributions and Roth conversions, is fully exempt from Illinois state income tax. This makes the Roth conversion strategy in Illinois particularly powerful. You pay only federal tax on the conversion, with zero Illinois state income tax on the distribution. In states like Iowa, Oregon, or New Jersey, state income tax on conversions adds 4% to 10% to the cost of each converted dollar and must be factored into the break-even analysis. Here is the move almost nobody knows about, and it directly addresses Carolyn's immediate IRMAA crisis. Medicare allows you to appeal your IRMAA surcharge based on a qualifying life-changing event. Death of a spouse is explicitly a qualifying life-changing event under Medicare regulations. If your spouse died and your income dropped significantly, you can file Form SSA 44 with the Social Security Administration and request that Medicare use your current year estimated income rather than the 2-year look-back income to set your Part B and Part D premiums. Carolyn's 2024 MAG was $148,000, inflated by the $90,000 IRA distribution. Her 2026 estimated income is approximately $71,600. That income level puts her below IRMAA Tier 1 as a single filer. Her Part B premium drops from $454.60 to $185.00 a month. That is $3,235 per year recovered by filing a single form. Form SSA 44 is free. It takes approximately 45 minutes to complete. Most financial advisors have never mentioned it to a widowed client. File it. File it within 60 days of the life-changing event determination. Bring your prior year return and a projection of current year income. The Social Security Administration will review it and adjust prospectively. State nuance. The IRMAA appeal process is federal and uniform across all states. However, state-specific Medicaid buy-in programs, which allow near-Medicaid-eligible individuals to pay a premium to receive Medicaid coverage, interact with the Part B premium in ways that vary by state. In Illinois, the Medicare Savings Program can eliminate Part B premiums entirely for lower-income individuals and is worth reviewing simultaneously with the IRMAA appeal. This move must happen before death. Once you are a widow, the 5-year clock that protects assets in an irrevocable trust runs against you as a single applicant with no spousal buffer. The optimal time to fund an irrevocable Medicaid asset protection trust is while both spouses are alive, both have legal capacity, and the couple's combined income and asset picture can be planned around the trust's income distribution rules. Here's what the trust does. You transfer countable assets, the brokerage account, potentially the home, into the trust. The trust owns the assets. You are no longer the legal owner, but you retain the right to income generated by the trust assets during your lifetime. You retain the right to live in the home if the home is included. You do not retain the right to the principal. The 5-year look-back clock starts on the date of transfer. For Carolyn and Dennis, this should have happened in 2020 or 2021. The $190,000 brokerage account should have been repositioned into an IMAPT when Dennis was 72 and Carolyn was 70, and both were healthy. The look-back window would have closed in 2025 or 2026. Right now, the brokerage account would be fully shielded. Carolyn would be sitting on a protected asset rather than an exposed one. The lesson is not that Carolyn failed. The lesson is that the planning window for this tool is measured in years, and the medical event that ends the window can arrive without warning. State nuance. In Illinois, irrevocable trusts are recognized for Medicaid planning, but the Illinois Department of Health Care and Family Services scrutinizes retained interests aggressively. The trust must be drafted by a qualified Illinois elder law attorney, not a generic online template, and must explicitly limit retained interest to income only, with no retained right to principal under any circumstances. In New York, the IMAPT is among the most widely used Medicaid planning tools in the country, with decades of case law supporting properly structured instruments. In California, the trust strategy must account for the Medi-Cal rule changes enacted in 2024 that modified estate recovery pathways. Here is the move I told you to hold, the one that sounds impossible. It is called Spousal Refusal, and it exists in a small number of states as a legal instrument that allows the community spouse to refuse to make their assets available to the Medicaid agency for the institutionalized spouse's care. Under the federal Medicaid statute, states are permitted, but not required, to allow spousal refusal. The community spouse signs a document stating they refuse to cooperate with the spend down. The institutionalized spouse qualifies for Medicaid based on their individual assets alone. The state may pursue the community spouse for reimbursement, but may not deny eligibility to the institutionalized spouse while that pursuit is pending. This strategy is not available in most states. As of 2026, it is clearly available in New York, Florida, and a handful of other states. In New York, spousal refusal has been extensively litigated and upheld in the Court of Appeals. In Florida, it is recognized, but the state's right of reimbursement has been actively pursued in some circuits. It is not available in Illinois, which means it does not help Carolyn directly. But here is why it belongs in this bulletin. If you live in New York or Florida, or if you are considering a state change as part of your retirement planning, spousal refusal combined with the transfer of community spouse assets into an irrevocable trust creates a two-stage protection structure that can preserve virtually the entire estate, even when a nursing home admission is imminent. This is not hypothetical. This is executed in elder law practices in Manhattan and Miami every single week. State nuance. In New York, the combination of spousal refusal and a Medicaid asset protection trust, sometimes called the New York half-a-loaf strategy when assets are partially gifted, has been refined over decades of administrative practice and court rulings. The strategy requires an elder law attorney with specific New York Medicaid experience. It is not transferable to other states without legal review. The bottom line across all four moves, the Roth conversion ladder, the IRMAA appeal, the irrevocable trust, and the spousal refusal instrument, these are not exotic strategies. They are documented, litigated, federally recognized tools. What they require is a qualified elder law attorney, a fiduciary CPA, and, above all else, time. The time requirement is the one variable the system is counting on you to waste. Let me bring Carolyn back one final time. Carolyn Marsh still wakes up every morning in that Naperville colonial. Dennis's color-coded tax files are still in the cabinet. She hasn't moved them. She pays $454.60 a month in Medicare, Part B premiums, because nobody told her about Form SSA 44 in the 60 days after Dennis died. She files as a single taxpayer and pays $4,200 more in federal income tax each year than she paid on the same income with Dennis alive. And her $930,000 in countable assets sits fully exposed to the Medicaid spend down, because the spousal protection that felt permanent was contractually tied to Dennis's heartbeat. It is June 2026. The IRMAA appeal window for Carolyn's 2026 premiums has likely closed. Those premiums are already set based on 2024 income. but her 2027 IRMAA is still being determined. Her 2024 tax return income will set her 2026 premiums. Her 2025 return will set her 2027 premiums. Every year is a new window. Every year she can file the SSA 44 based on current year income. The window does not close permanently. It resets annually. The irrevocable trust window is still open. Today. Right now, in June 2026, Carolyn is 72 and healthy. She has legal capacity. She has an estate worth protecting. If she funds the IMAPT this month, her 5-year clock runs to June 2031. She will be 77. Statistically, more than 62% of women who reach 72 in good health survive past 77. The odds are on her side, but only if she starts the clock. The widow cliff is not a metaphor. It is a mathematical certainty for every surviving spouse who does not plan around it before the death occurs. The bracket compression is law. The IRMAA threshold compression is law. The elimination of the CSRA at death is law. These are not risks. They are scheduled events, triggered by grief, that the system counts on arriving before the planning does. This channel publishes early warning bulletins. Within 48 hours of a federal IRMAA adjustment announcement, a state Medicaid rule change, a Social Security survivor benefit policy update, the bulletins go to subscribers first. Subscribe. Hit the bell. When the 2027 IRMAA thresholds are released, when Illinois adjusts its MERP estate recovery rules, when the SSA modifies the Form SSA 44 life-changing event criteria, you will know here before your CPA's next quarterly newsletter gets to your inbox. Your sources are free. Social Security Act Section 1396R-5, the Spousal Impoverishment Statute, is on ssa.gov. The IRS bracket tables are in Revenue Procedure 2023-34 and updated annually at irs.gov. Form SSA-44 is at ssa.gov. Read them, print them, bring them to your next meeting with your elder law attorney and ask, specifically, what happens to my estate the day my spouse dies? Be Carolyn, who found this bulletin while Dennis was still alive. Don't be Carolyn, who found it 18 months after the funeral. I'll see you in the next bulletin.